Hi everyone, Donnie Schultz and Brace Home Loans here with your Friday market update, January 21st, 2022. We've had another volatile week for interest rates. Our sell-off continued on Monday. It has since bounced back, so even though the week has been volatile, our rates are almost identical to where we ended last Friday at the last update. Monday, tough day for rates, up another eighth. We've since bounced back and taken back those losses due to some stock market weakness, some technical adjustments as far as trading is concerned, and markets getting ready for next Wednesday's Federal Reserve interest rate announcement. That'll be big to determine what happens next with interest rates. So we might see a couple of slow days Monday, Tuesday next week. Expect more volatility Wednesday and moving forward. One of the most important things I want to go over is what's driving these interest rates. When we're talking to our buyers, how do we explain this in pretty easy to understand terms? The shift in interest rates right now is one of a few big shifts that we've seen over the last 10 years. Okay, what's driving rates higher is basic supply and demand. Pandemic hit, the Federal Reserve jumped in to provide liquidity to the market. They started buying mortgage-backed securities. It's the same thing that they did back in 2011 that drove rates lower. Okay, now what the Federal Reserve had to do because of inflation numbers increasing is they had to step in and tell markets, hey, we need to stop providing this liquidity. They have to slow things down. So the Federal Reserve has projected to markets that they are going to reduce and then eliminate their mortgage-backed security purchases. They are going to increase the federal funds rate to slow down the economy and fight against further inflation. And they're going to reduce the number of mortgage-backed securities and treasuries that they hold on their books. They're going to reduce their balance sheet. So that type of shift, it's taking one of the biggest buyers of mortgage-backed securities out of the market. And when there aren't buyers, what happens is the prices on these coupons move lower, rates move higher to entice more buyers to come in. So again, we are in the middle of what could be the fourth, big shift of the last decade. The first one, I'm just going to jump to a longer term chart here. The first one was in 2013, where the Federal Reserve announced their taper, their reduction of mortgage-backed security purchases, similar to what they just announced last month. And we saw rates move higher as these red bars add up and this line moves lower, interest rates move higher. Okay. The second big shift we saw in rates, moving from low rates to higher rates, was in 2016 after the presidential election, right? We saw a big shift for a few months and we saw rates move up probably about 0.5% to 0.75%. And then again in 2017 into 2018, we saw another bigger momentum shift move in rates as the Federal Reserve sped up their interest rate hikes and the economy was improving according to economic data. Okay. Now what we're coming off of is again that big liquidity push by the Federal Reserve that drove interest rates to historic lows, and here we are at the end of this, the tail end of this kind of consolidation path that we've now started to move towards higher interest rates. We have a little ways to go, right? If this is in fact a shift similar to 2013, 2016, and 2018, we're probably about halfway there. So, we've seen rates go from 3% to 3.5%. What I would anticipate, if this continues, that eventually we're going to get to 4%. That could take a month, that could take 6 months. Once we get to that level, markets should look to see what's actually going on, and we could see some potential reversals at that point and make a move back down towards lower interest rates. What does that mean to our consumers? I put together a link to a comparison for our buyers to look at. All right, this is what it's going to open up to. It's going to show you a $500,000 mortgage, right? At the rates at the end of December, 2.99% compared to today, 3.49, compared to where we could potentially be going, 4%. So you can see the impact of the monthly cost to these consumers. All right. One of the big things for our buyers is they are going to be frustrated that rates are moving higher and that their payments are moving higher. They're definitely going to be frustrated that there is very limited inventory on the market. We have seen some posts and some speculation that the eviction moratorium might add to inventory. I have some doubts about that when you actually look at the number of households that are delinquent on their mortgages. I have even more doubts when you look at the number of households that are actually negative on equity, where the servicing bank would be less lenient or less receptive to putting the money that is late on the back end of the term and letting borrowers pay that off when they eventually sell off their houses. So I think inventory is probably a problem for a while moving forward here. So we can't anticipate buyers to get any relief on that side. To avoid the frustration, what we want to do is we want to make sure that these buyers are in the best position possible to get their offers accepted. If you do have conventional buyers, you should definitely look into Embrace's Approved to Move Plus program. It's a full credit underwrite, so we take a borrower's income, asset, credit documentation. We have our underwriters sign off on it, so we have a credit commitment. Once they're through the credit commitment, we will actually evaluate the property on any offer that borrower is making, and we will try to guarantee the value on the offer. So we'll come up with a confidence level, and we will say that we will guarantee that value no matter the results of an appraisal. That allows our buyers to waive their mortgage contingencies, waive their appraisal contingencies, right? Because we're guaranteeing it, and we've already gone through the credit approval process. So we're going to have a borrower who is ready to close, with the exception of a title report. So if anybody wants any more details on that, shoot me and my team a message. We'll get that out to you. It's a great tool. No other bank's doing this right now in New York. We've had a lot of success with it. We've gotten a lot of accepted offers with it. Any questions, reach out anytime. Have a great weekend.